So what we're going to look at now is learning objective number 2, and learning objective number 2 relates to determining the inventory cost. So here we're going to look at calculating the cost of goods sold using different inventory costing methods. And here there is obviously choice. There is choice about how to determine the cost of inventory, and we're going to see how this choice can relate to the Profit Businesses Report. So let's start off and let's look at the first one we have in our list here, which is the specific identification method in order to determine what the cost of inventory is. So what we're going to look at today is we're going to look at this example, and this example lines up inventory acquisition as well as inventory sales, shows us when we're selling particular items of inventory. And so the question that we're asking here is, how much does this sale on September 10 cost us? So we sold 65 units. What is the inventory cost associated with the 65 units that we have sold based on the inventory that we have on hand? Now, as I mentioned, the first method we have available in order to account for inventory is the specific identification method. So basically, method is available where you can specifically identify the inventory units you are selling and therefore the costs associated with each of these pieces of inventory. So the question is here, based on the inventory items that we have sold, what is the actual cost of inventory when we use the specific identification method? Well, if we go back to our information up the top, so just above this slide, it says that the beginning inventory, 40 units, cost us $12 each, and then the purchase on September 4, so the first lot of inventory acquired for the period, costs us $13 each. So it tells us here in this scenario that we sold 30 of the original and 35 of the recently purchased units. So therefore, the original 30 costs us $12 each, and then the sale of inventory associated with the purchases here costs us $13 each. So if we look at slide 21, that is basically summarizing this information here for us. So if I zoom in on this so I can see it more clearly, what you can see there is there are two specific types of inventory sold, 30 at $12 and 35 at $13, which gives us a total inventory cost of $815. And that is the cost of goods sold associated with that particular transaction. So if we look at the following slide, that slide simply shows you where we got the numbers from. So if we look here on September 4, it shows you that we acquired 60 units at $13 each. We add that to the inventory we have on hand. That's in addition to the original 40 at 12. And therefore, when we look in this particular case of what we sold, we connect those sales numbers with the associated cost of that inventory to get our $815. So the question I have for you now is, which retailer is the specific identification model most appropriate for? Is it an antique dealer that sells antique furniture, antique items? Is it Aldi supermarkets? Or is it Bingley that sells appliances, electrical items, etc.? Indicate which one you think is most appropriate for the purpose of using the specific identification method. So how did you go there? The one that is best fit to use the specific identification method is the antique dealer, because you will find that antique dealers have a specific cost associated with each individual item they are selling. Their turnover is usually less, so they can better track what the actual cost of each item is they are selling, and therefore determine what the cost of goods sold is associated with each sale. So if we look at an alternative example, let's say we look at a used car dealer here, you can see every single car that they have here available for sale is different and unique in some way. So obviously they know exactly how much they paid for each of these vehicles. They know how much it costs them to possibly repair them or clean them, etc. And so therefore they specifically identify the cost of each of these individual items when they generate a sale to determine what their cost of goods sold is. Now, what happens if we're looking at a business like Aldi or Bingley that has high turnover of items that are identical in many cases? This makes it difficult, right? What happens if we cannot specifically identify each individual product and the exact amount we paid for that item? So let me give you an example. Here is a bottle of Mount Franklin. Now, usually in the workshops, when we're at university in class, I will ask students who has this bottle of Mount Franklin. Then I'll ask them to look at the barcode on the bottle. And what we generally find is that the barcodes are identical. So for example, some of you might have a jar of Vegemite in your refrigerator or cupboard at home. Now, if we look at the barcode on this particular jar, which is on the side here, so this is a 455 gram bottle of Vegemite, and on the barcode, the last 3 digits that I have here are 335. So if you go and have a look at this in your cupboard, and you can find this exact bottle of Vegemite, which is the 455 gram, as I said, does it have the barcode numbers on the end of 335? If you do have this jar of Vegemite and you manage to find it in your cupboard, you'll probably find that it does have the same barcode number again. So if Aldi stock jars of Vegemite at different points in time, just like if they stock bottles of Mount Franklin water at different points in time, and they pay different amounts for those pallets of inventory or those inventory deliveries, but they have the very same barcode number and they are mixed in with the stock that they have available for sale on the supermarket floor, how do they actually work out how much each one costs when we can't tell the difference between one delivered in batch 1, batch 2, batch 3, etc.? We need to apply an assumption. And there are a number of assumptions that we can apply in order to determine what the cost of goods sold in this case is. And remember, we need to apply an assumption because we simply cannot specifically identify what exact unit we are selling and which batch it may have come from or which order number it came from. So the first assumption that we can use is what's called first in, first out, which is the assumption where we assume we sell the first unit in first, right? The first unit in the door is sold first. Now, in the situation where we've had recently with panic buying, this is a very valid assumption because the first unit a retailer gets in is the first one out the door. As buyers panic buy, they buy whatever's on the shelf, they clear out the shelf, the retailer restocks, they clear out those items again, and therefore they need to restock. So this is a valid assumption. The first inventory in the door is the first out the door. So that means that when we determine the cost of goods sold, we assume that the first unit we are selling is the first unit we have acquired. So if we go back to this particular example, where we are looking at a situation where the business has sold on September 10, 65 units of inventory. Right? Now, the 65 units is all we know about the inventory items that we have sold. So how do we determine the cost of them when we purchase different batches at different costs? Well, again, we don't know which particular batch that inventory is coming from because the barcodes on it is exactly the same. So just like if we have batch 1 of Vegemite for Aldi or Woolworths or Coles, batch 2, etc. They may have paid different amounts for this Vegemite, but the product and the barcode on the back is exactly the same. So how do we determine the inventory cost? Well, here we made the assumption that first in is the first out. So that means at the beginning of the period, we have 40 units of inventory on hand. That costs us $12 each. So when we're selling 65, we therefore assume that the first lot in, 40 at 12, is completely sold. So once we completely sell that 40 units at $12 each, we then assume we get into the second lot of inventory, which is the 60 units we paid $13 each. So we sold 40 from the first lot we had available, which means to bring this up to 65 units, we need to take an additional 25 units out of the next slot we got in stock, which cost us $13 each. So 25 times 13 gives us $325 of inventory sold, plus the first lot, which is $480 worth, which was 40 times $12, which means based on the first in, first out method, our cost of goods sold here for this particular transaction is $805. So to show you a little bit more clearly on the next slide, what this is indicating here is where the numbers are coming from. So just like I explained, first in, first out. So the first lot, we assume we sell first, so 40 at 12. Then we go to the second lot, 60 at 13. We only need to take 25 out of that, which is where the 25 here comes from, and the 13 associated with the second batch in, giving us our amount of $805 as our cost of goods sold. Now remember, as I said before, this first in, first out method of determining inventory cost is based on the assumption that we sell the first lot of inventory is sold first. So that is first in, first out. And in these times of panic buying, which is fortunately seems to have passed us largely, this is a very valid assumption. But remember, it is an assumption. In retailers, buyers might be picky and choosy. They might select an item of inventory that was not necessarily the first in. And so therefore that violates the assumption we're applying here. So for example, when I go to Aldi, I bought this bottle of milk, right? Now you'll notice on the top of this bottle, it says the use by date is the 11th of May. Right, so I'm filming this video on May the 1st. So 11th of May is the use by date. Now, where did I get this bottle of milk from when I turned up to the milk section of Aldi? Did I take it from the front of the refrigerator section? So did I take the first one that I could get my hands on? Well, the answer is no, right? So I don't want the one that's been there the longest, which if you've worked at a supermarket, you know that the one that is going to go out of date first, you put up the front of the rack so customers take that first so you don't have to dispose of it. If you simply shove the next lot of milk in front of these, eventually the ones with the use by date that is coming up first would be shoved at the back, and therefore no one would access them, and therefore they would have to be disposed of when they go out of date. So therefore, in that particular case, how Aldi is managing their operations, or many supermarkets are managing their operations, Coles, Woolworths, etc., they're managing it so that the first in is actually the first sold. Right? Now, when I go there, as I mentioned, I don't buy the first one I can get my hands on. I push all the other ones out of the way and I go to the back of the refrigerator and I get the one with the longest use by date, right? So therefore, the first one that Aldi got in, or Coles got in, or Woolworths got in, is not the first one out. The last one that they may have got in is the first one out in my particular case. Now, on average, do people do this? Well, on average, the answer is no. They don't do this. They simply buy the one at the front of the rack, which is the first one in, which is therefore the first one out. So on average, the first in, first out assumption works for retailers generally, but as I'm emphasizing here, it's an assumption and it is not absolutely correct in all cases. Now, if we now go to another assumption, which is the last in, first out assumption. So what this assumes is the last unit a retailer gets in is the first one that they sell. So last in, first out the door with the customer. Now, this assumption is obviously less applicable because, for example, supermarkets like Coles, Woolworths, Aldi, IGA, Costco do not want to sell the last in, first out because that means they'll be left with the items that came in first, which will go bad, as I just explained, with the first in, first out method, and they will need to dispose of them. So it's relatively rare you will find that this method is used in business. And certainly in Australia, as I'll explain in more detail in the following objective, this method is banned in Australia. So you can't use it here. It is not applicable in Australia. However, it can be used in other countries. And as many of you will work overseas and use information from entities overseas, you might find the last in, first out method has been used. And so therefore we cover it in this particular subject. So getting back to exactly how you calculate the cost of goods sold using the last in, first out method, as you read the method here, last in, first out, which means that we're looking again at the sale on September 10 of 65 units. So what we're looking at is selling the last in first, right? So the last in prior to the sale on September 10 was the purchase one on September 4 of 60 units at $13 each. So obviously we're selling 65 units in this case, so we completely use up that last lot in on September 4, 60 at 13. Now remember, the sale relates to 65 units, so there are still another 5 units we need to deliver on. So we go back to the second last purchase that the business made, which is reflected here, which is the 40 units at $12 each. So we take 5 units out of that, $12, giving us $60 there. So we add up the total here and we get $840 of cost of goods sold associated with this. Now this is obviously higher than the first in, first out method that we looked at previously. And the reason for that is you can see that the cost of inventory in the case of the transaction we're looking at on September 10, that inventory cost is increasing up to that particular sale. So in that case, when you use the first in, first out method, you assume you are selling the lowest cost units first, whereas if you're using the last in, first out method, you're assuming you're selling the highest cost units first, and so therefore the cost of goods sold associated with the last in, first out method is higher in this particular case. So the last method available to determine the cost of goods sold that we look at today is the moving average method. So as the name suggests, you assume you sell the average inventory you have on hand. So in this case, we're still looking at the same 65 units that we sold on September 10. We need to determine what the average cost of units on hand was at the time of the sale on September 10. Remembering here, we're using the perpetual inventory costing system, which means that we record the cost of goods sold at the time of sale. So in this particular case, we need to work out what the average cost of inventory is on hand at the time we sold this 65 units of inventory. So what you can see here is that they had 40 units at 12, 60 units at 13, and so the total cost of inventory that they had on hand on September 10 was $1,260 worth. So that means that the average cost per unit is $1,260 divided by 100 units on hand equals $12.60 per unit. So you multiply 65 units by $12.60 and you get $819. So the type of businesses that will be using this type of method are, for example, petrol stations. So petrol stations will, of course, have a mix of inventory on hand. So when the tanker fills up the tanks that are underground below the petrol station, if there is any fuel that is within that tank when they fill up, it obviously mixes in and stirs in with a new fuel that is injected into those underground fuel tanks. So therefore, when the petrol station sells fuel to a customer, they sell the average fuel that they have on hand, and they'll need to calculate the average cost of that fuel per litre. Now, incidentally, we do know it mixes in because in Europe they have a law that you are not allowed to buy, or the retailer is not allowed to sell you fuel within 30 minutes of the underground tanks being refilled. And the reason for this is they know that the fuel stirs together as well as contaminants that can be sitting on the bottom of the tanks underground can also be stirred into the fuel. And so if you buy fuel and you inject that into your car, you can of course inject the fuel and the contaminants that are floating around in that fuel into your petrol tank, which is not so good for your vehicle. So they impose this rule where they have to not sell fuel from a particular tank that has been refueled within half an hour. So the contaminants can float to the bottom once again, so the fuel is clear from those contaminants when people purchase that fuel. Okay, so an interesting fact to keep in mind related to the mixing of inventory together for the purpose of determining your cost of goods sold. So, as I just mentioned, to calculate the weighted average cost of inventory, we need to determine what the average cost per unit is. So in order to do this, you apply this formula here. So cost of goods available for sale divided by the units available for sale. That will give you the average unit cost. You can then multiply that average unit cost by the number of products you sold within a particular transaction, given we're using the perpetual inventory costing system, where we determine the cost of goods sold at the time the transaction occurs.